I observe in the current euro crisis not merely a monetary turbulence but the systematic dissolution of the most ambitious political project in Europe's post-war history. What has been unfolding since the pandemic and intensified by the energy crisis within the eurozone economies qualitatively surpasses all previous currency crises and documents the structural impossibility of a single currency between fundamentally divergent economies. The irony is unparalleled. A currency that was intended to deepen European integration becomes the wedge that divides the continent into irreconcilable creditor and debtor nations. This development is occurring 20 years after the introduction of the common currency, at a time when all the structural contradictions that critics predicted from the outset are becoming visible with devastating clarity. The euro functioned only so long as cheap energy, low interest rates and global growth concealed the fundamental asymmetries between the German export economy and the southern European consumption economies. Once these conditions disappeared, the monetary union proved to be a system of organized exploitation of the periphery by the center. The speed of this unmasking surprises even seasoned economists. Within 3 years, the eurozone transformed from an apparently stable monetary area into a powder keg of diverging inflation rates, exploding interest spreads, and insoluble trade balance asymmetries. The European Central Bank stands before insoluble dilemmas in which every decision disadvantages one group of countries in favor of another. The euro was conceived as a political project intended to overcome economic realities through political will. Optimum currency area theory had already warned in the 1990s of the risks of a monetary union between countries with differing productivity levels, inflation traditions, and fiscal cultures. These warnings were dismissed as technical concerns that could be overcome through European spirit. The fundamental miscalculation lay in the assumption that a common currency would automatically lead to economic convergence. Instead, the euro systematically reinforced existing differences. Germany was able to expand its competitiveness at the expense of its partners through wage dumping and export increases, while southern European countries lost their traditional adjustment mechanisms due to overvalued exchange rates. Particularly pernicious was the construction of ECB monetary policy, which was oriented towards German stability preferences, but applied uniformly to structurally different economies. What constituted appropriate monetary policy for Germany proved for southern Europe to be either a deflationary shock or an inflationary stimulus depending on the business cycle phase. The Maastricht criteria cemented these asymmetries through deficit limits that favored export-oriented countries and disadvantaged import-dependent ones. Germany was able to build fiscal room for maneuver through export surpluses, while deficit countries were forced into pro-cyclical austerity programs that intensified their problems. At the same time, the institutional mechanisms for a transfer union or fiscal integration which a functioning monetary union would require were absent. The euro was a hybrid between nation-state fiscal policy and supranational monetary policy, a construction that cannot function in the long term. The Target 2 balances documented these structural imbalances at an early stage. Germany's claims rose to over 1.2 trillion euros, while Italy and Spain accumulated corresponding liabilities. These figures do not reflect temporary imbalances, but systematic capital flight from the periphery to the center. Germany today operates as a reluctant hegemon, increasingly perceiving the costs of the monetary union as unbearable, while simultaneously benefiting from the advantages the euro creates for German exports. Berlin's position is fundamentally contradictory. On the one hand, Germany rejects a transfer union and fiscal integration. On the other, it wishes to preserve the monetary union, which could only be stabilized through such mechanisms. The German strategy is based on the illusion that other countries could, through structural reforms, be brought to achieve German-style current account surpluses, a mathematically impossible undertaking, since not all countries can simultaneously be net exporters. This ignorance of fundamental macroeconomic identities renders German European policy detached from reality. Particularly problematic is Germany's refusal to acknowledge its own role in the emergence of the crisis. Through wage dumping, corporate tax concessions, and a mercantilist export focus, Germany has pursued a beggar-thy-neighbor policy within the eurozone that systematically weakened its partners. The Bundesbank and the Federal Ministry of Finance systematically block all attempts at European fiscal integration, as this would create German transfer obligations. At the same time, Germany benefits massively from low interest rates resulting from ECB policy primarily addressing southern European problems. Italy positions itself as a frustrated debtor, torn between eurozone membership and national sovereignty. Rome can neither fulfill German structural reform demands nor bear the interest burden of its public debt without ECB support. This dilemma leads to growing anti-euro sentiment among the Italian population. Italy's dilemma is particularly acute as the country is both too large to fail and too large to rescue. With 2.7 trillion euros in public debt, Italy exceeds the financial capacities of all potential rescuers, while an Italian exit from the eurozone would signify the end of the common currency. Italian politics oscillates between an EU-conform reform course and populist anti-euro protest. This oscillation is rooted in the objective impossibility of achieving both fiscal stability and economic growth within the eurozone. France acts as a declining mediator, attempting to reconcile German stability demands with southern European growth needs, but increasingly becoming a problem case itself. Paris can neither challenge German dominance nor credibly lead southern European solidarity, as France's own fiscal position is precarious. The French strategy of European integration as a solution to national problems no longer works, as Germany rejects integration and southern Europe doubts French solidarity. Macron's European vision fails against German and Italian realities. The European Central Bank finds itself in an impossible position as a crisis manager, expected to solve structural political problems with monetary instruments. Through quantitative easing, the ECB can temporarily resolve sovereign financing problems, but simultaneously creates new distortions through asset price inflation and the zombification of inefficient structures. ECB policy is systematically discriminatory. Low interest rate policy helps indebted countries but harms German savers. Interest rate increases stabilise the euro but endanger southern European sovereign financing. There is no monetary policy that is optimal for all eurozone members. In the current development, I recognise three critical escalation paths that go beyond monetary problems and endanger Europe's political unity. First, spread divergence leads to the systematic segmentation of the eurozone into different risk classes. German bonds yield negatively, while Italian BTPs carry risk premiums of 200+ basis points. These spreads reflect market expectations of potential euro exits and create self-reinforcing speculative dynamics. This development is particularly dangerous as it reinforces Target 2 imbalances and accelerates capital flight from the periphery to the center. Italy systematically loses liquidity to Germany, weakening Italian banks and strengthening German ones, a vicious circle that can only be broken through political intervention. Second, fiscal fragmentation intensifies into a systemic conflict between national democracy and supranational rules. German demands for a Schwarzer Null collide with Italian growth requirements, while EU fiscal rules contradict democratic electoral decisions. This tension is fundamentally irresolvable, as fiscal sovereignty is the core of democratic self-determination. Countries that can no longer determine their own budgetary policy are, in effect, no longer sovereign democracies. The eurozone stands before a choice between democratic legitimacy and fiscal integration. Third, the inflation-deflation scissors develop into a macroeconomic wedge. Germany benefits from moderate inflation that improves its export competitiveness, while southern Europe must combat deflationary tendencies in order to reduce debt servicing burdens. The ECB cannot simultaneously serve German and Italian needs. I project three likely development paths from the current currency crisis. In the first scenario, persistent divergence leads to the gradual disintegration of the eurozone. Italy introduces a parallel currency, Greece returns to the drachma, and other peripheral countries follow successively. Germany and the Netherlands retain the euro as a northern euro, which mutates into a new Deutsche Mark. Europe returns to national currencies that enable adjustment through flexible exchange rates. In the second scenario, an acute crisis leads to the chaotic implosion of the common currency. An Italian or Spanish sovereign financing crisis triggers panic selling, the Target 2 system collapses, and the ECB loses control. Emergency measures such as capital controls and bank holidays cannot prevent the collapse. Europe experiences the greatest currency crisis since 1945. In the third scenario, the crisis forces fiscal integration, in which Germany accepts a transfer union to save the euro. German taxpayers finance southern European budgets, while European institutions assume national financial sovereignty. This could stabilise the monetary union but would fundamentally transform German democracy. The concrete figures of European economic development already document the systematic divergence within the eurozone. Germany's current account surplus rose to over 8% of GDP since the introduction of the euro, while Italy, Spain and France developed structural deficits. These asymmetries are not cyclical but systemic. Particularly dramatic is the development of unemployment rates. Germany reduced unemployment to below 3%, while Southern Europe struggles with structural unemployment above 10%. This divergence documents the differing impacts of uniform monetary policy on heterogeneous economic structures. Productivity development shows similar patterns. German productivity rose by over 30% since 2000, while Italian productivity stagnated. This divergence renders a common currency unsustainable in the long term, as it creates systematic competitive distortions. Inflation has diverged for years. Germany experiences moderate price increases of around 2%, while Southern Europe struggles with deflation risks or hyperinflation. The ECB cannot simultaneously guarantee German price stability and Italian reflation. The euro crisis is not merely an economic issue, but a fundamental political problem as it exposes the limits of European solidarity. German voters are not prepared to finance unlimited transfers to Southern Europe, while Italian voters are not prepared to accept German reform demands. This political reality renders all technocratic solutions to the euro crisis impossible. Fiscal union requires German willingness to make transfer payments, which does not exist. Structural reforms require Southern European willingness to accept social cutbacks, which is absent. Opinion poll data brutally document this division. 70% of Germans reject Eurobonds, while 60% of Italians condemn German austerity policy. These figures reflect fundamental conflicts of interest between creditor and debtor nations. Particularly problematic is the erosion of democratic legitimacy through EU fiscal rules. Countries whose budgetary policy is determined by Brussels cannot practice authentic democracy. This democratic hollowing out strengthens populist movements that propagate EU exit as the recovery of national sovereignty. The Troika policy in Greece, Portugal and Ireland already demonstrated the authoritarian implications of the monetary union. Elected governments were compelled to implement policies they opposed. This is democratic regression through monetary integration. What I recognize in the euro crisis is not merely the failure of a currency experiment, but the unmasking of European integration as a projection of political wishes onto economic realities. The euro was meant to create European unity but produced European division. The irony lies in the fact that a return to national currencies could paradoxically unite Europe, as it would end the systematic exploitative relationships created by the euro. Flexible exchange rates enable adjustment without political conflict. The coming decade will show whether Europe has the courage to correct course or whether it will break upon the contradictions of an impossible construction. The alternative to an orderly dissolution of the euro is chaotic collapse. The euro was a great experiment, but failed experiments must be ended.